Welcome to this week's Nebraska Soybean Board Weekly Market Roundup, brought to you by Nebraska soybean farmers and their checkoff. I am Steve White, and joining us today on the program, we have Shawn Hackett from Hackett Financial Advisors, as well as Jeff Peterson from Heartland Farm Partners. And guys, we're going to just get a quick headline or two, each of you. Shawn, let's start with you. What's something that's been notable to you out of the last 7 days here?
Well, I think the meshing of the escalation of geopolitics with the renewable diesel mandates, and obviously the up to this point fairly benign weather here in the U.S., are all kind of battling for first place in how the grain markets are trying to move, and I think that'll continue to be the battle going forward as we move into the key month of July.
And Jeff, a quick headline from you.
Yeah, the biggest things I think is building off what Shawn talked on. It's just that we continue to see the weakness in the old crop corn market, which was actually rather, tight on stocks, but yet getting a little bit of strength in new crop. But it's been really good to see, based off of the stronger, soybean oil prices, what we've been able to have a higher soybean market. So that's a few things I'm seeing.
Well, very good. We're going to dig more into that to get their thoughts on the market trade this week in just a moment. But first, a word from Nebraska soybean farmers and their checkoff.
It may be small, but this little bean fuels a lot of power. It powers a food industry as a top source of protein. It's a fuel that powers diesel engines with fewer emissions. It powers a state economy and bottom lines. And it powers the rest of the world as a top Nebraska export. Yeah, it may be small, but we're finding more ways for this little bean to power Nebraska.
Welcome back to the weekly market roundup. As Shawn mentioned just a moment ago, we've been seeing a situation, geopolitics, things intensifying in the Middle East. And I'm sure we know that's had an impact on things. Shawn, let's start with you. What are you looking at, and what kind of impact might we be seeing? A situation seems to be escalating that way.
Well, obviously the geopolitical instability increases energy prices on the worry that there'll be a disruption of supply, which then impacts fertilizer prices. And obviously energy and fertilizer have a lot to do with the input side of the equation, and tends to create a bid underneath the grain markets. And if this escalates, if it becomes where the U.S. is getting involved and it's becoming a widespread Middle East affair, then it would be a factor that would tend to drive not only, corn and soybeans higher, especially like the bean oil market that tends to be sensitive to energy prices, but it would also could potentially make wheat go up if the thought process is that this might disrupt flows coming out of Russia, Ukraine.
And Jeff, what about you? What are your thoughts on the Middle East situation and that conflict?
Well, the biggest thing I'd see is that we definitely know we've got a war premium or a conflict premium that we've got built into this crude oil market. And where it goes from here really kind of depends on what the countries, what Israel and the U.S. looks at for what does Iran look like after this all ends. If you think about it, they probably aren't going to go after the oil infrastructure right now, only because they probably want to still have some type of economic engine there afterwards if there's some thought that there's going to be some type of regime change. So then you have to look at what happens if Iran does something to block the Strait of Hormuz. So if we dig in and look at that, Iran itself produces about 4% of the world's, think of it as energy from crude oil, but overall that Strait of Hormuz makes up about 20% of all the world exports out there. So as you have that, if something happens with that, then we'd see a greater escalation in price.
Something certainly we're going to want to keep following. Jeff, let's go back to you. Just in general, how do you feel? What's your overall feeling as we look just at corn and soybeans, just in general, big picture right here, as we said at this point?
Yeah, big picture, I've been very happy with what we've been seeing happen on the soybean side, and that much of that was being fueled by the stronger soybean oil market, which came really because of the proposals on the RVO. Been very disappointed in what we've been seeing in the corn market. The funds are short the corn market, and they continue to sell it. What's been a little bit confusing is the fact that we have been having a little bit of strength coming in the new crop side as opposed to really on the old crop side. But I think we've got a lot of positioning there and thinking about where does everybody want to be going into our quarterly stocks and also planted acreage report at the end of the month.
And Shawn, what about you? Do you share those thoughts or differ at all? What do you think about just the general position we're at on corn and beans?
It just seems to me that, a lot of people overbought old crop corn ahead of tariff war and the uncertainty over it. And that what we're seeing in the spreads widening back out is that the demand just doesn't need old crop corn right now, but they're looking for value in the new crop, obviously with the key part of the growing season still in front of us. Obviously, the expectation is that most of the acres that we suggested we were going to plant at the end of March at the planting intentions report will have gotten planted. And that means that the bar that corn needs to get over to get itself into a tight spot is a little harder to come by than in the soybean market, where even a small adjustment downward in yield would create a situation where we could be looking at pipeline levels being reached fairly quickly with this increased demand for bean crush. And so I think that's why the corn market struggles, and it needs to see hot weather and some dry weather coming into July into the core grain belt in order to override the worry over too much corn being produced when we start harvesting in the fall.
And Jeff, what do you think it's going to take to see the corn and bean markets move higher from where we are right now?
Well, I think as we dig in and look at it, I think Shawn did a nice job laying out there. We definitely do need to have a forecast that shows hotter and drier conditions that happens over, at least, 35, 40% of the corn belt. Be nice to have it over more of that. Now, we know in the Western corn belt, we've got some warm conditions coming in here. Get a lot of questions from people. Why isn't that causing the market to go up? Well, because immediately after that in the Western corn belt, we've got some really nice rains coming in. Demand has been holding in very good on the old crop side, whether it's the ethanol, whether it's the exports. We know on the feed, it's a little bit harder to tell, but we'll get better insight into that as we get to the quarterly stocks. And then coming back on the bean side, really, we just got to kind of to keep this market moving higher, continuation of what we have. Now, when I say that, we had some decent export numbers today. Our crush numbers are good. And in addition to that, the NOPO crush numbers that came out last week would have suggested that we were sitting on some of the lowest soybean oil stocks going all the way back to 04. So what we've got is that we've really got a nice setup on the bean side. And then the big question comes in is that what happens on the acre side as we come in on the quarterly stock side. It'd be great to be able to see corn acres coming in less than what the market's thinking. I don't think that's probably the case. I think if there's a surprise, it probably comes in a little bit higher. But that's the type of thing we'd have to see to get this market continue to move higher.
Shawn, let's send it over to you. Jeff was mentioning that quarterly stocks, the planted acreage report. What are you anticipating? What do you think we might be seeing there?
Well, I kind of think all this cold, wet weather we had in the Ohio Valley and this deep south, southeast, with the more favorable, warmer, drier weather we had in the central west, central north grain belt, I think they're going to offset each other. And I really don't think we're going to see the numbers statistically that much different from what we saw. Normally there is a big change. I just think this is a year we could be 500,000 acres one way or the other, but I don't think we're going to see the acreage report make too many changes. And I really don't think we're going to see the quarterly grain stocks really show any major surprises. I kind of think for once we actually might have an end of June uneventful set of reports, which normally makes the market move. I still feel, there could be some positioning of some jockeying around, some square positioning and such going into and through it. But for the most part, July weather is going to rule the day, notwithstanding what's going on with the geopolitical situation.
Well, I want to talk about Fed policy. Let's do that in just a moment. But first, a reminder, you are watching the Nebraska Soybean Board Weekly Market Roundup, brought to you by Nebraska soybean farmers and their checkoff. Shawn, as we think about the Federal Reserve Fed policy, does that have any implication or does that have the ability to move some markets here?
Well, I don't think it's the interest rates that matter a whole lot. I think it's when they stop quantitative tightening and move back to quantitative easing. Right now, we have about $12 to $15 trillion of government U.S. debt that needs to be rolled over the next 12 months. And the only way historically we're going to be able to move that kind of quantity is if we print more money to support the bond market so the interest rates don't go up too high on the 10-year and on the 30-year. And so what I'm looking for is not necessarily interest rate policy. I'm looking at when they're going to shift to a more accommodative monetary quantitative easing policy to manage this big roll that's coming up. That would enhance the weakness we've seen in the US dollar over the last 3 or 4 months. And anytime we get a dollar continuing to move down over time, it does tend to have a long-term inflationary effect in U.S. priced agricultural commodities. So I think that's the sign to look for, not interest rates.
And what about you, Jeff? Do you have any thoughts on, the central bank and interest rates and the value of the dollar? And what are you watching that way?
Sure. No, most definitely. What's been very helpful here lately is to have some weakness in the U.S. dollar. We know when we put that in a good position, everybody wants to talk about the U.S. dollar index, but really what we have to go and take a look at is that how are we stacking up versus the Brazilian real. One thing that's helped us, I think, on the export side to make us more competitive on probably the bean side and also keep us competitive on the corn side also is the fact that we've really seen some weakness in the U.S. dollar back against the Brazilian real. And that's definitely helped us. So I'm going to continue to watch what the U.S. dollar does, mainly against the Brazilian real. We know that basically we can look over and see what's going on against China, but we know for the most part they're pretty well pegged against us.
Well, guys, we've come to the end of our time. It's time to wrap things up. Let's get a closing thought from each of you. Anything you're looking forward in the days to come, Shawn?
I really think the most important thing is to watch the weather models outlook in the first half of July. I think if we start showing some warmer, drier temperatures that are being suggested by the longer term models on a 2-week forecast, I think we'll get some short covering in the market once we get through the month-end reports.
And Jeff?
Yeah, so going to watch very closely what information comes out in the reports at the end of the month, but also watching weather closely. The thing I want to keep always in the back of my mind is the fact that we know that the subsoil moisture levels in Nebraska, for instance, are rather dry. We know there's also parts of Iowa and parts of northern Illinois where that's the case also. So we're going to be watching those weather forecasts out there very close. We're going to be watching them two ways. One, to see if we can get some hope that we can get a bounce in the market because of dry conditions. But we're also going to be watching it from the standpoint that if we get down the road another couple of weeks and then the 2-week forecast still looks pretty good, then we start getting to the point the market gets even more confident that it can put some more pressure on the market. I don't think that's how it's going to play out, but we have to keep that open as an option.
Well, some great insights. Thanks once again to Shawn Hackett from Hackett Financial Services and Jeff Peterson from Heartland Farm Partners, our guest this week. As a reminder, commodities futures options trading involves a substantial risk of loss and is not suitable for all investors. And that is this week's weekly market roundup, brought to you by Nebraska soybean farmers and their checkoff.